Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, it's been 2 weeks since I published the last Damien Midweek Markets show, and despite the fact that the Easter holiday fell in between, a lot has happened in a relatively short space of time. Now, the market itself has continued to rally. So if we look at the S&P 500 to start with, then we are up just below 2,800 on the S&P 500, which is above the 2682 where we were just before Easter. If you look at the FTSE 100, then we've gone from 5642 to around 5770. But that only really tells part of the story, because during that time, we've actually continued to rally. The rally that started at the end of March, in the last week of March, we've rebounded and we've rallied high. And that rally has continued, but it's been starting to butt against some resistance levels. Some key resistance levels are the 2,800 level on the S&P 500. Psychologically, that's a nice round number. And oddly enough, for us humans, we like nice round numbers, and so we sort of gravitate towards them. So it always seems to provide at least a weak line of resistance or support, depending which way the market's moving. But above that, we are heading back towards the 50-day moving average on the S&P 500, which is up around 2,840, so 2,840, and we've broken above that in the last week or so, and then pulled back below it again. And so the market is trying to work out which way it's going to go. And as I mentioned 2 weeks ago, we're at that point now where we are looking likely to find out very soon whether this is just a bear market rally or a more sustained move higher back towards some of the highs we've seen recently. Now, in the last video, I talked about some of the indicators that suggested that we weren't at the woods yet. The VIX was up around 43. It's still up around 45. 10-year US Treasury yields were still pushing lower. In fact, we've headed back towards the all-time lows since then. And the market breadth had actually improved, and we were starting to get up towards some crucial levels that might indicate that we're about to break higher on the US stock market and therefore have an impact on global stock markets, a positive impact. But we've since pulled back on that. So the breadth hasn't really improved enough to confirm that this is anything more than a bear market rally. But of course, we've got to wait and see. And by breadth, I'm talking about the number of stocks that are pushing above their recent highs, their 50-day moving averages, for example. Now, there are some stocks out there that are having a great time of things. Very few, but if you look at the technology sector, technology stocks have done relatively well in the coronavirus period. If you think of your own lifestyle, you've been in lockdown, the things that you are doing or using, they are mostly tech focused. So Amazon, for example, has just hit a new all-time high, which is an incredible feat in a market such as this, given the sell-off. But Amazon is back setting new all-time highs. The other stocks within the sort of tech-heavy NASDAQ have also been relatively buoyant. So we've seen some strength there, which is a positive. But going forward, we'll have to see whether they can maintain that and drag the rest of the market higher, because despite the fact that they may be doing a lot of the heavy lifting, if you want to see a sustained rally, you want to see that improvement in breadth. Because at the moment, there are about a handful, half a dozen stocks that are doing most of the heavy lifting out there, the likes of Microsoft and the likes of Amazon. Now, the other thing to bear in mind, I mentioned on the last podcast and video about valuations. And having looked at the analysis since then, the valuation levels of the stock market, again, we're looking at the S&P 500 here, are looking quite frothy. So if you think about the PE ratio, so it's basically the price to earnings. So it looks at the share price, what you would pay for the earnings per share. So as that gets higher and you're starting to pay more and more and perhaps overpaying for stocks, then you are more prone to a pullback. If you look at history, then on the S&P 500, it's typically around about 17 and a half times forward earnings that you get a pullback. it's not certain, it's not like a one-in-one relationship, but as an indicator, it starts to suggest that perhaps the markets are getting carried away with themselves. Well, at the moment, we've seen the market rebound so strongly, but with earnings and forward earnings that are very questionable, and we've actually had forward earning guidance from companies as earnings season gets underway that's actually been reduced. That has put the valuations of stocks almost back to where they were before we had this coronavirus sell-off. So back towards the levels they were in February when they were expensive. So I get a lot of people start talking about, is this a good time to get into stocks in terms of valuations? There's some bargains out there. If you look at them as a whole group, you could argue we're at a point now where valuations are back towards levels we saw in recent history before a sell-off. Certainly on an absolute price level, if you look at the S&P 500, we're back at levels we saw in May, June last year. But the economic fundamentals have obviously deteriorated massively. If you think about in America, we saw US economic numbers that were pretty dire. We've seen the retail sales in America fall by almost record amounts. We've had similar predictions of an economic contraction of up to 20% in the UK in the latter part of this year. But also, we have now seen 20 million Americans have to sign on for unemployment benefits, or at least register. And that means, to give this some context, that means that if you look at the jobs created, the additional jobs created since the financial crisis going back to the beginning of that recovery about 11 years ago, the 20 million jobs that the US created in that interim period have been all but wiped out in 3 to 4 weeks by the coronavirus. So that is an incredible statistic, and is almost pointing towards depression levels of economic contraction. And so investors who are buying stocks now at these valuations are obviously banking on a quick turnaround, a V-shaped recovery. And of course, stock markets do discount the future, so they will bottom and recover before the economy does of itself. But either way, that's very stretched. Now, we're back above that 17 level, as I said, which makes them expensive. But of course, these earnings levels could come in even lower than anticipated. So earnings could be completely decimated. If that happens and the stock market continues to rise just towards, let's say, 3,000 again, we'll be talking at a valuation level of 20 times forward earnings, which is incredibly expensive on the S&P 500. So that's where we are at the moment. So it's basically buyer beware. That doesn't mean there's not individual bargains to be had within sectors, individual companies, but we are in a world which is unprecedented. It's very difficult to predict where the landmines are when you are picking stocks, because you're not quite sure what's going to happen in the future in this environment. With markets pushing up against those resistance levels, as I mentioned, we are still seeing central banks pumping money. We are still seeing rate cuts out there. We're even seeing America announcing more stimulus packages. It's almost too difficult to keep up with all of this. And so the market is trying to hang in there, and there are people trying to buy the dips. It'll be interesting to see what happens in the next few days if things go lower. It is interesting also to see Donald Trump tweeting once again about Iran and threatening to shoot any ships that actually stop the oil tankers passing through the waters near Iran. And of course that could inflame things with Iran again, which was something we had back in January. So all of this in the mix, so keep an eye on headlines. But talking of oil tankers and the oil market, one of the things I wanted to focus on this week is just to try and explain what happened in the oil market. Now, you would have seen headlines that said that the price of oil had fallen below zero, which is quite an incredible thing to even think about. So what happened on WTI, which is the West Texas Instrument oil price? It's basically a futures contract. It's a financial contract, and what happens is traders buy these contracts, and what they do is they say that the traders will buy or take delivery of 1,000 barrels, say, of oil at a particular date. Now, in the last couple of days, we had one of those contracts due to expire, and it did in fact expire yesterday. What has happened is, with the coronavirus impact globally on the economy. It's sapped demand. So we've had people in lockdown, we have had businesses shut down. It's caused a drop in demand for oil, and that's not just from industry in terms of factories and in production, but also from consumers in terms of oil, petrol, usages for vans, vehicles, etc. So the demand has plummeted to almost unprecedented levels, which means that there's an oversupply of oil. With demand falls, that supply-demand metric, if you remember Economics 101, what's happened is the supply has been maintained, but the demand has fallen, which means that the price, therefore, has started to fall. The oil market is a market that's dominated by OPEC, which is a series of countries which produce basically all of our oil. And they effectively rig the market and negotiate the production that each country is going to produce, and that in that way it will control the price of oil, because obviously they're very reliant on the revenues generated from oil. So people like Saudi Arabia, for example. And what's happened is they've not cut oil production quite at the rate that they probably would need to offset this fall in demand. So with oil prices falling, on top of that, oil has to be stored. So it's got to be stored somewhere. So these storage facilities, particularly in America, have become full. So there's nowhere, if you take delivery of oil, to store it. It's because you're going to have to pay for storage of oil. So you're going to get these barrels turn up. You're going to have to end up storing them somewhere. That's caused a problem. So the traders who have these contracts, what they usually do is they don't actually take delivery of the oil. They usually end up selling these contracts onto somebody else, a refinery or another business that actually wants the oil. So they sell them on at a profit. With the bizarre situation where we are in now, with a collapse in demand for oil and a falling price, we got to a situation where traders were very quickly realising that they were going to have to take physical delivery of this oil, and started to panic. So they started to try and offload these contracts. That in turn therefore drove down their price, which is why the price started to head towards historic lows, and it went through zero, even though that seems strange to an ordinary person who's just thinking about it, a negative price. It went down to minus $40 a barrel, and effectively what those traders were doing were trying to offload them so they didn't have to take delivery. It is a quirk of the environment we're in, coronavirus, and also the way these oil contracts work. But the bottom line is, if you remember in recent history, stock markets have been following the oil price quite closely, not necessarily in correlation, but what I mean is that when the oil price has dropped significantly, markets have tended to pull back. And that didn't happen quite in the same way this time around. And obviously energy stocks did, and you'll see the FTSE 100, which has a lot of oil companies in it and oil exposure. It fell in the last few days. But what we've seen is it drag on stock markets, but perhaps not to the level we might expect. What I'm getting at is that in such a bizarre situation, such extremes, it seems very unlikely that the market can ignore it forever. So although we've seen some recovery in that price of oil, I do wonder what will happen in the sort of days and weeks ahead. So it's worth keeping an eye on the story surrounding oil prices. So that's where we are right now. The other thing to chuck in there, if there wasn't enough to be worried about, is earnings seasons. We're going to start to see some more, or gain more insight into the earnings of companies in the last quarter, but also their projections for earnings going forward. So we will start to see some of the impact of the coronavirus shutdown, and have markets baked enough of that into the price of stocks. Given the recent rebound, we will find out. So it feels like we're coming to a crucial time for stock markets. Will this just be a bear market rally that eventually turns over and rolls lower, or will it become sustainable? Now that is it for this week on Damien's Midweek Markets. As ever, you can contact me. Damien@moneytothemasses.com is the email address. Of course, you can contact me on Twitter, moneytothemasses with the number 2, Instagram and YouTube. Don't forget to subscribe to our YouTube channel, and on Facebook, do make sure you join our Facebook group. You can ask questions on there about anything, not just investing, anything to do with money. You'll get a lot of helpful responses, and if you want to find that group, it's Facebook midweek.com/groups/money to the masses.